Hi, hearty welcome to yet another interesting iLead Tax Talks. Thank you very much for joining us today, and thank you so much for all the appreciation, love, and support. Without that, I cannot come up with these videos. Yes, I do teach at iLead Tax Academy. Now I am kind of feeling, that I'm becoming a teacher for my clients at iLead Tax LLC. So kudos to all of you. Thank you very, very much for supporting me here. Well, I am Nandakumar KV, CEO of iLead Tax Group. I run two businesses. One is my passion, iLead Tax Academy, and other one is my profession, a practitioner at iLead Tax LLC. So thank you very much. Whether you are my student or my clients, if you have joined today's session, hearty welcome to you. So today we are discussing one of the most painful and misunderstood topics for Indians living in the US. That is, of course, PFIC, Passive Foreign Investment Company. Some of them have started calling me as the PFIC guy. Anyways, so if you are in the US and you hold Indian mutual funds, ELSS funds, or certain other foreign pooled investments, this is not a small issue. This can become one of the most expensive compliance mistakes in your entire tax life. Today I'm going to break this down in very simple language. Of course, there are so many tools now. You have AI tools, you have Google, you have so many things. Okay, so most of them are into IT field, my clients. So we are also into IT, income tax field, but I'm sure you will have a much bigger edge than all of us here. So we will cover what PFIC is, why Indian mutual funds become PFIC for US taxpayers, why gifting does not automatically solve the problem, what mark to market means, what happens if you sell, and how to exit PFIC strategically instead of emotionally. In the past four series, also, if you are watching PFIC 5, I encourage you to first watch those four videos and then come and watch this. Nandaji, do you want us to watch all those four videos, boring videos? I don't know. If watching my videos is free of cost, then paying taxes at 37% or 40% on PFIC, I would encourage you to please watch this, then do some research. Like हमारे हैदराबाद में एक बात बोलते हैं, सबका सुनो अपना करो. सबका सुनो अपना करो. So listen to what I'm saying and what other industry experts are also saying. Do your own research and then arrive at a conclusive evidence. Yeah. So this session is primarily for Indians in the USA, or anybody who is a non-US citizen, non-US national who is making his or her living in the USA. So primarily you can call this as a session for H1B holders, L1 holders, green card holders, US citizen, and any US tax resident who has investments in India. And let me say this very clearly at the beginning, this is not just a tax filing topic. Okay, this is a financial decision topic. Done right, it can save you thousands. Done wrong, it can create taxes, interest, penalties, and years of stress. Okay, let's get into the session. Every slide has its own point to convey. So, as I said, this is not just a tax topic, this is a financial decision. Every year, many Indian professionals in the US come to US after they discover PFIC very late. Usually, the story is the same. They invested in India before coming to the US. They continue holding these funds and they assume they only need to worry when they actually sell it. Or they assume India has already taxed or exempted it, so the US will leave it alone. That assumption is where, the problem begins. In that assumption, the problem begins. The US taxes the US persons on worldwide income. Are you getting it? The US taxes the US persons on the worldwide income. And for PFICs, the US has a very special, very harsh regime, under the Internal Revenue Code. And we should not be skipping that piece of it. I'm getting, a lot of questions from the clients, even, the new people. So the AI or the YouTube is kind of presenting, all the iLead videos to them, in their search and things like that. And they are worried. Now, I encourage them, to do their own research and then, definitely come to me. But please do your research. Please do some homework. Today, there are so many tools, out in the market which is available. ऐसा नहीं है कि you just have to rely upon iLead or go back to your accountant and then start yelling at them. Now the way things were earlier in the US, now the way the things are in the US, I mean most of the IT professionals you must be knowing. Did you had this $100,000 fees earlier? No, right? So things are changing and things have changed a lot. So it is not to blame anybody, but it is to figure out. It's the way, how you fix the problems and ensure, that you stay compliant rather than, cribbing about what has not happened. It is important. Some of them, they don't even know about FBAR and FATCA. If you have more than $10,000 outside of USA, you have to file something called as FBAR, Foreign Bank Accounting Report. It's quite disappointing, that people don't know such basic thing also. But anyways, I don't know. Uh, that's why I very much encourage my clients, to focus on planning rather than filing. Planning, filing, and all, anybody can do filing. If he is a licensed enrolled agent or a licensed certified public accountant, anyone can do planning. But the real thing is, anyone can do filing, but the real thing is planning. Planning kaise karna hai? That is something that makes the experienced people be have a higher leverage over others. Anyways, as I said, the US taxes the US persons on worldwide income. When I say US person, it includes US citizen, US national, and then US residents. And for PFICs, the US has a very special, very harsh regime under the Internal Revenue Code. I did walk you through section 1291, and through 1298 and all, in the earlier sessions. Now, Form 8621 is the reporting form used by US shareholders of PFICs, including for distributions, dispositions. whether it is QEF reporting, and even Section 1296 mark to market elections. So the real goal is not panic, the goal is to understand the rules before you make the next move. Okay, and we will be learning it step by step today. Now, let us start with the foundation. Now, why do Indian mutual funds become PFIC? Why do Indian mutual funds become PFIC? See, a PFIC is a passive foreign investment company. In simple language, if a foreign corporation mainly earns passive income like dividends, interest, capital gains, or mainly holds passive assets, it can fall into PFIC classification. That is why foreign mutual funds are the classic PFIC example. So if you are a US person and you hold Indian mutual funds, the US tax system generally does not treat them like normal US mutual funds. Instead, they often fall into PFIC treatment, which means Form 8621 may be required, and the tax rules can become much harsher than the normal long term capital gains treatment, wherein you get taxed at 15% or 20% or sometimes 0% also. And the IRS instructions for this Form 8621 confirm that US persons file the form when they receive certain distributions, recognize gain on disposition, report a QEF or mark to market election, or in other specified PFIC situations. Now, here, if you see, the slide says highest tax regime, and for teaching purposes, that's the right message actually. I mean, highest tax bracket. What that practically means is under the default section, that is 1291, gain on a disposition is generally treated as an excess disposition, excess distribution, allocated across the holding period, taxed under special rules, and can carry an additional interest charge. The IRS instructions say the entire amount of gain from the disposition of a Section 1291 fund is treated as an excess distribution. And that is why this is dangerous. Dangerous. Yeah. So, suppose, Ravi invested 20 lakhs in Indian mutual funds in 2018. By 2026, the value becomes 45 lakhs. If Ravi is a US tax resident and sells without any prior PFIC election strategy, he may not get the normal I held it long term, so I get favorable US capital gain treatment result he was expecting. That's not going to happen. Instead, the default PFIC rules may apply. Right? Now, from the from my desk, say client hold funds without knowing consequences. If this video is creating any awareness about this particular topic, you're able to research and then make a own decision. I'll ignore it. I'll do it. But research, talk, get a consultation. Getting a consultation is not saving money. And there are so many other planning areas, than PFIC. But given the struggle that the non-immigrants go through, especially people on H1L1, I felt as a practitioner, it's my responsibility that I educate the viewer on these topics. And of course, they can have a consultation with their own accountant or dive deep into this particular topic or schedule a call with me, and I'll be happy to clarify. At iLead, we see this every single day, especially now in the tax season. That's why, my focus is more on the planning than on the filing. So, I'm sorry to my some of my clients, who are just filing. The priority now is more on planning. Yeah, the team and all, they are there, with the filing activities, but I'm focusing, more on the planning and the consultation side of it. Yeah, I love, talking to clients. Well, a client says, sir, this is just SIP. Another says, Nandaji, this is just ELSS. Another says, this was started by my father many years ago. Another says, this is through NRO account. So maybe US tax doesn't apply because it's exempt in India. That is the confusion gap. The IRS doesn't care that in India you call it SIP, ELSS, AMC, or tax saving fund, whatever. The IRS cares about how the investment is classified under the US tax law. Getting it? The IRS cares about how the investment is classified under the US tax law. And that is why the first victory is awareness, knowing about this. So before strategy, before filing, before tax projections, the first victory is simply understanding, will I have a PFIC exposure? Yes or no? Okay. So today morning, I was talking, to somebody who got my video on the YouTube, and then he scheduled a call with me. So I thought, I'll just take his situation and then talk to you. This client is in the US, married filing jointly, around 300,000 household income, and holding approximately some 1.7 crores worth of Indian mutual funds. Then the client asks a question that many people usually ask me: can I gift these funds to my parents in India and avoid US tax entirely? This is a brilliant question, emotionally. But legally and tax wise, it is not that simple. And this is why planning matters. Because when people discover PFIC, their first instinct is not strategy, their first instinct is escape. See, there's a difference between escaping taxes and then avoiding taxes. Okay? Evade and avoid. English terms, right? Escaping is illegal, avoiding is legal. You can avoid taxes on certain things by making right steps, by taking right strategies, by implementing right decisions. Imagine a software engineer in Texas or New Jersey. He came to US in 2020, COVID ke time pe. He had Indian funds from before immigration. Nobody told him about PFIC. By 2026, the portfolio is large. He now wants a clean exit. That is exactly the kind of person I was talking to this morning. And this presentation is primarily, for those kind of people. Okay. You have my coordinates below. You can write to me. That's my email address जो ऊपर लिखा है यहाँ पे asknanda@ileadtax.com और हमारे numbers भी दिए गए हैं. Even if you are a US citizen, green card holder in India, you have our Indian number. You have our US number also. And you can see the Calendly link in the description, YouTube link and all. Okay. Now, see, good intentions without planning can lead to tax exposure. Agree? Good intentions without planning can lead to tax exposure. See, the instinct to gift is understandable. The client is thinking, if I transfer it to my mother in India, then I no longer hold it. So maybe I am out. But the tax law is designed specifically to prevent easy escape routes. Here is the key message you should remember. If you are a US person and you dispose of PFIC stock, you gain recognition, and PFIC and you gain recognition, then PFIC reporting can be triggered. The IRS instructions for Form 8621 specifically requires filing when a US person recognizes gain on a direct or indirect disposition of PFIC stock. A gift can also raise separate gift tax reporting issues under Form 709 if the amount exceeds the annual exclusion limit, which keeps changing year after year. So gifting is not some magic eraser, that we see in Canva tool. It is a transaction that itself must be analyzed. Gifting strategy. Now, the big question: can you escape PFIC? Gift it away, ignore it, or delay it? See, let us answer the three most common emotional reactions. Number one, can I gift it away? क्या मैं ये बेच सकता हूँ? I mean, क्या मैं ये तोहफा दे सकता हूँ किसी? See, gifting may be part of a strategy, but it is not automatic tax elimination. Getting it? It is part of the strategy, but it is not automatic tax elimination. It still has US reporting and tax consequences to evaluate. Then the number two is, can I ignore it? Can I ignore it? Very dangerous. See, Form 8621 exists for PFIC reporting. F bar and Form 8938 जो FATCA बोलते हैं may also apply for foreign accounts and specified foreign financial assets depending on the facts and thresholds. I keep saying this again and again. A US person with foreign financial accounts generally must file an F bar if the aggregate value of all his holdings exceed $10,000 at any time in the year. And Form 8938 is required when these specified foreign financial assets exceed, the applicable threshold, whether 50,000, 75,000 for single or 100,000, 150,000 for married. Now, number three, can I just wait until I move to India? Just delay it. Delay doesn't solve the historical US problem. It may make it worse because the default Section 1291 regime can apply interest charges tied to the prior periods. So the answer is not to run, the answer is to plan. Now, what clients are really asking? Some ask escape, some ask strategy. Actually, many ask strategy, a few ask escape. So, what clients are really asking is not what is the best long term tax design. What they are really asking me is how do I get out without pain? That's natural, but this is where, an advisor like me, practicing from the last 22 years, may add value to you. A great advisor does not just answer the technical question, a great advisor reframes the question. The wrong question is, how do I avoid PFIC? Getting? The wrong question is, how do I avoid PFIC? The right question is, how do I exit PFIC in the least damaging, most compliant, and most practical way for my income, for my family, my resident plans, and my cash flow. That my is not the same as compared to your relative, friend, or colleague in the US. Are you getting it? लेकिन उनको तो नहीं पता, वो तो 10 साल से बैठे हैं, शायद किसी ने नहीं बोला उनको. And this is a cross border tax. This is a cross border tax. India US taxes. Cross border tax. So obviously if you're working with a US CPA or a US EA, they may not have, complete knowledge on PFIC unless, they have been actively practicing that particular area. ऐसा ज़रूरत नहीं है कि every CPA EA should know all the tax topics. Are you getting it? Now, if you come to me and ask, Nandaji, please guide me on heavy duty vehicle taxes, I myself don't know, but I have connections where I can get that work done. That's not my area. Just like, a doctor will not deal with, neurology, cardiology, whatever logies are there. One person will not be specialist in everything. What they call it as, jack of all trades. ऐसा नहीं होता है. If somebody is there like that, that's a rare exception. So work with somebody who is able to give you clarity in what you're talking to that person. That's important. Now, the hard truth. The hard truth is PFIC cannot be escaped. वो आप ध्यान से याद रखें आप. The hard truth is PFIC cannot be escape. See, you cannot usually outsmart PFIC with shortcuts. The IRS has a defined framework. The recognized buckets are basically one default Section 1291 treatment, then two, the qualified electing fund or QEF wherever available. Then the three is the Section 1296 mark to market election for marketable PFIC stock. And then the actual disposition events, including taxable exits that must be reported and all. The IRS 8621 instructions and related regulations outline these paths. So when I say PFIC cannot be escaped, I mean this. It has to be managed inside the tax law, not outside it. You're getting it? And don't expect me to give a customized answer to your particular situation in this live video. See, if your house is on the wrong road, you do not solve it by closing your eyes and continuing to drive. You solve it by taking the right exit, right? So PFIC is the same. Now, accept this. Okay, acceptance is the first step. That there is something like this. Now it is up to you whether you want to implement it. Getting it? Accept it. एक बार डायबिटीज आ गया तो एक्सेप्ट इट कि आपको शुगर थोड़ा कम खाना है, गॉड फॉरबिड, आपको कम खाना है, थोड़ा सेहत पे ध्यान देना है, वॉकिंग करना है, थोड़ा एक्सरसाइज करना है, संभाल के खाना है, ठीक से सोना है, ज़्यादा स्ट्रेस नहीं लेना है. I mean, body demands that after a particular time period. See, once the client accepts that PFIC is a strategy problem and not an ignorance problem, the conversation becomes, more productive. That is when, we can ask, should we use MTM? Should we sell? Should we give? Should we do a hybrid? Should we first clean up old years? Do we need to also file FBAR or FATCA over the previous years, by amending the tax return? And that is what real planning looks like. That is what looks like. Now, I'll tell you, what are your three legitimate exit options, from this PFIC. Let us walk through, the three practical exit from the slide. Option one, mark to market, जिसको प्यार से लोग MTM बोलते हैं. Option two, full sale or disposition. And option three, gift to a non-US person. Like I said, parent in India. Each path is legal. Each path is legal. And each path has trade-offs. Each path needs documentation, and the right answer depends on the person sitting in front of you. Let's see. Strategy 1, MTM, mark to market election. See, under section 1296, okay, though you are IT guy, थोड़ा ले लेना है, okay, आप research कर लेना फिर. Under section 1296, certain marketable PFIC stock can be marked to market. That means at year end, you treat the stock as if it were sold for FMV, fair market value, on the last day of the tax year. So the gains are generally included as ordinary income, and losses are allowed only to the extent of prior unreversed inclusions. The IRS materials and final regulations under section 1296 describe this framework, because some people were asking me where in the IRS code it is there and all. So for the benefit of those people, I'm giving you this. Okay, I don't like to use all the sections, internal revenue code and all, but I got some queries where it is in the IRS that it is, so you can dig deep on those particular sections. Now, what is the advantage of this election? The advantage is this: you avoid the cruel section. Yes. Cruel section 1291, excess distribution regime for that stock while the MTM election is in effect. The regulations coordinate Section 1296 with Section 1291. So that Section 1291 generally does not apply to distributions or disposition of Section 1296 stock for the taxable year. Little technical, but I'll try to simplify that. Now, what is the disadvantage? You are choosing annual taxation. Also, the gains are ordinary, not favorable long term capital gains. But still, MTM is often best for a US resident who plans to continue holding the PFIC for some time and wants predictability. So, suppose Brinda has Indian mutual funds worth $100,000 at the start of the year and 115,000 at the year end. Under a valid mark to market framework, she may include the 15,000 increase as ordinary income for the year. Getting it? Rather than letting the entire gain sit there and potentially become a Section 1291 problem later. So, MTM is not painless, but it is often cleaner, than letting PFIC become a time bomb, for lack of better words. Next. So, that is strategy number one. Now, the strategy number two is sell. Let us discuss sale. See, selling all PFIC shares gives you one major benefit: finality. Finality. Once you dispose of the PFIC and file the required final year, Form 8621 correctly, you have a clean exit from future PFIC ownership for that particular asset. The IRS instructions make clear that gain on disposition is a core Form 8621 trigger. बेचोगे म्यूचुअल फंड्स इंडिया के तो पिफिक का ट्रिगर आपने दबा दिया. ओ मैं पहले भी बेचा था, अब तक मुझे कुछ नोटिस नहीं आया नंदा जी. प्रेज गॉड. God loves you. But the downside is the tax hit. If no valid mark to market or QEF regime was in place, sale may trigger the default Section 1291 rules. And that is where people get shocked because they expected maybe long term capital gain style treatment, but instead they face special tax and interest computations. I was talking to a couple last week, and the wife was literally in tears when they realized, their tax implication and all. I feel sorry for them, but I can only give you advice. I can only give you a consultation. Implementation is definitely, your decision. So sale is often best for someone who says like, I want simplicity. I'm willing to pay tax now to stop the headache forever. Let's close this types. Let's say Saravana has 60 lakhs of Indian mutual funds. He is now a green card holder, settled in the US long term, and he never wants to think about Form 8621 again. For him, a clean sale, painful it may be better than dragging the issue for another decade. Just close it. Close it. That's the second strategy. Sell. The third one, gift to a non-US person. Something that I didn't cover in the last four PFIC series. Gift strategy. So we come to the slide that many people care about most: gifting to a parent in India. Now, let me explain this carefully. Yes, a US person can make a gift to a non-US person. A US person can make a gift to a non-US person, but when the gift is large enough, Form 709 can be required. Form 709 is the US gift tax return, and the annual exclusion is $19,000 for 2026. This keeps changing. A gift tax return is generally due on April 15th, following the year of the gift, though extensions apply. So, if you are giving a gift in 2026, you will have to file a gift tax return by April 15th of 2027 on Form 709. Now, from the PFIC side, if the gift is a disposition, means sale for US tax purposes, and gain is recognized. So, Form 8621 analysis is still very much on the table because recognized gain on disposition is a filing trigger. Getting it? So, gifting can be part of a PFIC exit strategy, but it is not no tax, no reporting, all problems solved. Getting it? What gifting can potentially do is shift future ownership away from the US person. That may reduce future US PFIC exposure after the transfer, but it does not erase what must be reported up to and through the transfer event. Uh, so, to cut the story short, gifting may still create a US taxable or reportable exit event for the donor, and the transfer must be documented properly. Getting it? Now, see, here is where I want you to slow down and think like a planner, not just a filer. मुझे वो clients बहुत पसंद है जो plan करना चाहते हैं taxes, who want to plan the taxes. I mean, filing and all, based on your budget, you're okay to spend, $200 $300, for a simple return. Please go walk, straight into some H&R block. Okay, you don't need any consultant, you just want to file online, without anybody's help. Go file with TurboTax. I myself am telling you that. Yeah, you want somebody, yeah, please pay some extra dollars and get some expert consultation. But if you are working, with a person like us, you can first get educated on what this is all about. And here is where I want you to slow down and plan. Don't just file your taxes, plan. Even if you are those, who have gone back to India for good, or or planning to move back to India for good. Even my clients from other countries also, wherever, जहाँ भी हैं आप, make sure you have this kind of a conversation with your accountant. I mean, somebody is filing the return, for free for $10, $20. I mean, that should not be your decision making premise. That should not be a ground. I mean, whom are you working with? Are you working with a licensed CPA? Are you working with a licensed enrolled agent? Are you just working with somebody whose name only you see on the tax return, but you've never seen the person like this? Or you cannot talk to them over phone or email or schedule a Zoom consultation, especially if your case is a little complex or it needs, planning and things like that. So whichever country you are, make sure, that you plan your taxes. Don't just file your taxes. Chalo. Now, these are the 4 questions I want you to ask yourself. Question 1. Are you staying in the US long term? Let me have a sip of water. Yeah. Sorry for this long video, but the topic is like that. And I'm doing my best to make sure, that I give you most of the information. So, question number one. Are you staying in the US long term? If yes, carrying PFIC complexity forever is not advisable. Question 2. Do you want simplicity? Yani, if simplicity matters most, you want to keep things simple, straight. A clean disposition can be attractive. Question 3. Are you comfortable paying tax now, given your financial conditions? Some people would rather pay now and sleep peacefully. Others need to smooth, tax across years. And finally, question 4, is family wealth planning part of your goal? If yes, gifting may fit broader family objectives, but only when structured correctly. A strategy is good only if it fits the human beings. We're all made of emotions, sentiments at the end of the day, not just, some codes, sections, and all. Yeah. And here at iLead, we do not start with what does the law allow in theory. We start with what is your residency path, what is your income band, what is your filing status, what is the holding period, what other foreign assets do you have, do you also have FBAR or FATCA issues, what is the India side, what is your family goal, what is your liquidity as of now. So it is more of what is suitable and not just what is possible, because a strategy that works for a 29-year-old H1B employee is not the same as what works for a 48-year-old green card holder with US born children. So don't expect everything to be made available in a video like this. Trust me, I'm really doing my best in giving you this content. A lot of clients who know the pain of, and also some of the peers also, though they don't like me professionally for offering this free consultation, they do appreciate for the value that I bring, because your compliments, your engagements, it motivates me to give more information like this. Yeah. Now, the best strategy, a hybrid approach: sell part, gift part, and then exit completely. Let's see. So this is the slide I personally like the most, because this is where planning becomes practical. For many clients, the best strategy is not one extreme. It is a hybrid. Sell part, gift part, exit perfect completely. कभी हम दावत पे जाते हैं, right? Oh, there is vegetarian section, there is non-veg section. But non-veg का बंदा होता है जो दो तरफ हाथ मारता है. पहले नॉन-वेज खा लेता है, फिर जाके देखता है वेज में क्या है. ओह, पनीर टिक्का है, ले लेंगे. So do a balance, okay? Sell part, gift part, exit perfect completely. So why does this work? Because sometimes the client wants some immediate liquidation, given the uh, conditions that's now prevalent in the US. They want to also have the liquid funds, so maybe they want to pay tax on part now and clean up the highest risk or most appreciated position. At the same time, they may want to transfer part to India, their family, for some genuine reasons. So done properly, that combination can reduce future US PFIC exposure, spread out the planning impact, and create a more emotionally acceptable path than either sell everything today or hold forever and hope for the best. So take this 1.7 crore client. Maybe the client sells 30 lakhs worth, pays the resulting US tax cost with eyes open, and gives the balance to his mother in India. under a documented gift transfer plan, and that is very different from acting, randomly. So I call this as a balanced strategy philosophy. Right combination, right time, right client. No single strategy is always best. MTM may be best for one client, full sale may be best for another, gift may be best in a family planning scenario, and hybrid may be best when the facts are mixed. The skill is not in memorizing terms, like this MTM, PFIC, Form 862, and or Forms 709. Students or my fellow practitioners, the skill is combining them in the right sequence. आप क्लाइंट को डराओ भी मत, and students also, don't dig too much on this. I mean, don't try to research too many questions for particular client, for one single client. Those are your questions. Okay, those are your questions. But for that particular client, it's not needed. It's not at all needed. So learn to limit your conversations to a particular client, even if there's a peer in the industry watching. Okay, very, very humbly, I wanted to present that. Now, let's talk about this. Why March execution delivers the best results in case, because the tax season time. Why is early year execution powerful? Because if you decide early, you avoid year end chaos. You know what you are doing. You gather documents while the information is fresh. You reduce the risk of sloppy valuation and bad records. For gift strategy, this matters even more. You need clean records of the transfer date, the fair market value, gift documentation, and the fact pattern around the disposition and reporting. Form 709 is an annual return for reportable gifts during the calendar year. And gift tax returns, as I said earlier, are generally due April 15th of the following year. Also, remember the extension is for filing and not for paying tax due. The IRS extension guidance is very clear on that general principle. So, January to March is not just a scheduling preference, it is a risk control strategy. I've just given an example so that it becomes easy for you. So, in January, you can plan and decide. February, execute the transactions. March, close and document. And April, file clearly. Now, सब अच्छा है नंदा जी. What happens? What happens if I ignore? The real cost of ignoring PFIC. What the IRS sees when you don't file. You may call this as a fear slide, but I think I should give you this information also. See, first, the underlying PFIC tax problem does not disappear. The first thing. Second, you may also have foreign reporting exposure depending on your facts. US persons with foreign financial accounts over the threshold, like more than $10,000 in case of FBAR, and specialized or specified foreign financial assets over 100,000 or 150,000 if they are married, will have to file FATCA, Foreign Account Tax Compliance Act, Form 8938. The IRS itself publishes a comparison, of Form 8938 and FBAR requirements. If you go to Google and type Form 8938 versus FBAR IRS, you will get, some IRS related articles. So you can clearly see that. Probably I'll try to make another video. What all comes in PFIC, what all comes in FBAR, what all comes in FATCA also. Because the FinCEN explains the FBAR threshold rule better. Third thing is, delay can increase the economic pain because Section 1291 carries an interest component tied to the PFIC regime. I told you this. So ignoring PFIC is not passive, it is active self damage. Active self damage. A client thinks he is saving $2,000 in preparation fees, to the EA or CPA by ignoring PFIC. 5 years later, he or she may face far more in tax, interest, reconstruction work, and stress. And that is false economy. And that's not a wise move at all. Now, where clients lose the most money, not because of tax itself, but because of lack of planning. Not because of tax itself, because of lack of planning. This slide captures what I have been seeing, repeatedly in the practice. Many clients do not lose the money most because the tax law exists. They lose most money because they wait, they assume, they postpone, and then they act emotionally. The first loss is ignorance, the second loss is delay, and the third loss is documentation failure. By the time they ask for help, the strategy options are narrower. Well, quick compliance checklist, Form 8621, Form 709, and then the evaluation. Let us get practical. So, if you are exiting PFIC, what are the compliance anchors? Number one, Form 8621. This is the anchor document for PFIC reporting. I'm sure by this time most of you must have seen how a PFIC 8621 looks like. Yeah. The beauty of every IRS form is it will tell you who is. And remember Bahubali 1 trailer, my konu. Yeah. Name everni. Nan yar. So it will tell you who is. So this is the anchor document for PFIC reporting. The IRS says a US person files Form 8621 in specified situations, including distributions, gain recognition on distributions, on dispositions, QEF reporting, and then the MTM reporting. That is the first one. Number two, Form 709. If there is a reportable gift. For 2026, the annual gift exclusion is $19,000 per donee. If the transfer exceeds that, Form 709 may be required. The return is generally due April 15th of the following year. And number three is valuation and records. You need reliable fair market value support from your Indian investors wherever you have invested. So, in a mutual fund context, that may mean NAV statements, broker statements, transfer records, and any other relevant documentation. So, if the paperwork is weak, then the strategy will also be weak. Now, what are some of the common PFIC mistakes that costs clients, not my clients, some viewers who are not my clients, dearly? Because my clients, they make wise steps. Okay, so kudos to my clients. I call them zimmedar taxpayers. Zimmedar, responsible. Now, they think no tax, no reporting, ignoring the gift reporting, and not worrying, much about the records. Let's go understand, these three mistakes one by one. No tax means no reporting. Wrong. Wrong. PFIC reporting can be required even when the client does not emotionally feel like something happened. Form 8621 has specific filing triggers and also a limited annual filing exception tied to thresholds and facts. But many taxpayers do not understand when that exception truly applies. The current IRS instructions discuss the $25,000 threshold for certain annual filing exception purposes, with 50,000 for joint filers and all. But having said that, that is not the limit that you have to rely on. Because even if you sell Indian mutual funds for $5,000, the sale is still taxable in the US. Yes or no? The sale is still taxable in the US. So that's the first mistake of assuming that no tax means no reporting. Now, even if you don't have to pay tax, you still have to report your PFIC. Even on FBAR and FATCA, you don't pay tax. I mean, when I tell clients, do you have more than $10,000 in India? The couple started seeing each other as if I'm some CBI officer or FBI officer. I mean, वो तो आपका यूएस का आफ्टर टैक्स मनी है ना जो आप इंडिया बेच रहे हो इंडिया बेच रहे हो that's the after tax money that you're sending to India or money that was there in India before you came to US is just asking you to report that F bar statement report foreign bank accounting account report that's all FATCA foreign account tax compliance act form 8938 just reports है ये statements है ये tax return nahi hai. There's no refund in this, there's no O in this. So please be clear on that piece first. Clear? F bar, FATCA. They are statements. They are reports. Mistake 2. Ignoring the gift reporting. If you make a reportable gift, Form 709 is not optional. Just because no immediate gift tax is paid. The IRS makes clear Form 709 is used to report transfers subject to federal gift tax reporting. And finally, the mistake 3, weak documentation. Weak documentation. If you cannot prove date, value, and transaction details, you weaken your own defense. So, finally, don't escape PFIC. As a CEO, as a chief education officer, I want to say don't escape PFIC. Exit PFIC strategically. Strategically. This is the message I want every viewer to remember. Do not try to escape PFIC. Exit PFIC strategically. That means understand what you own, understand your tax residency, understand your reporting, understand your options, and then make a deliberate move. Tax filing, you say, reports the past, but tax planning shapes the future. And PFIC is where the difference becomes very, very expensive. Very expensive. And that difference changes everything. Getting it? That difference, that changes everything. See, we do strategy. Anybody, can react to a deadline. The real value is in planning before the deadline creates pressure. And that is why in PFIC work, the real work is not just preparing, some form 8621. The real work is, should you elect MTM? Should you sell? Should you gift? Should you split the strategy? Should you fix prior years? Do you need FBAR or FATCA alignment also? What year is best to sell or gift? What cash flow do you have to absorb? All these things, that is what is planning. So, if your facts are simple, you may now understand, enough to ask better questions. If your facts are not simple and most perfect cases are usually not, then you definitely need, a personal strategy. In an iPlan session, we look at the holdings, the holding period, the likely PFIC exposure, your residency plans, your family structure, and then we model the options. Not everybody should do the same thing. Oh, my friend didn't do this, my colleague didn't do this, my relative, my uncle, mama didn't do this. Stop all that. Stop guessing. Anyways, Just a disclaimer. This session is educational. It is not individualized legal or tax advice. PFIC outcomes vary based on elections, holding periods, filing history, account structure, residency, and family facts. So before you sell, gift, elect, or amend, get case specific advice. And if this video helped you, share it with another Indian family in the US, because, and also, ask your HR to organize, free tax webinars. I would love to do it free for you. Because many people are sitting on PFIC exposure and do not even know it. So don't try to escape PFIC. Exit PFIC strategically. Yeah. Let me know your comments on this video, and if you want me to make more videos on any other interesting taxation, please feel free to write to me. That's my email address, asknanda@ileadtax.com. See you soon in the next iLead Tax Talks. Take care. Bye-bye.